Okay, welcome everyone. Hello. Hello and welcome to the webinar titled IRA Tax Recapture. And just to clarify, IRA stands for any qualified account. So it doesn't necessarily have to be just an IRA. It could be a 401k, it could be a 457, a 403b. Any type of qualified account will work with the strategy that I'm going to be talking about today. I am your presenter, Roman Inokovsky, wealth strategist and owner of SkyWealth Alternatives. And the lady you see down at the bottom, Mary Reed, is the National Director of Pension and Protection Planning Retirement Services. She is kind of the compliance officer that I work with. She works very closely with the IRS, and we all work together so that we come up with the best solutions by all regulations and by codes. Well, I can congratulate you, and I will tell you this: most of you are going to be very happy that you found your way to this webinar today. And just in case a friend referred you, then you will want to maybe thank him later. The wealth strategy that I will be revealing to you today, in just a few minutes, could potentially keep several hundreds of thousands, I'm not exaggerating, several hundreds of thousands of dollars or more in your control and give you more cash for retirement and create a larger legacy. As I said, I am not kidding. This is a very unique strategy and it works. So I realize that you are very busy, and with respect to that, I'm going to let you know right off the bat who can benefit from this wealth strategy, what benefits you could receive, and how it works within the IRS codes. And I will try to do so within 40 minutes. Hopefully we can do it a little bit less, but I'm giving myself about 40 minutes. Please know that when you are interrupted and you have to walk away, don't worry about it. You'll be able to watch the replay because I will be sending you I will send you a replay via email at a later point. And I also suggest for you to grab a pen and a piece of paper to jot down any questions, and I will give you the opportunity to schedule a one-on-one personal call with me at the end of the presentation. So let's get started. We typically look at individuals currently aged between 50 and 65. We'll explain later on why. Currently have an IRA of 500,000 plus. Could be $1 million, could be more, right? I can tell you we don't have to necessarily use all the money in the qualified account, but you can. So you have the flexibility in that. Someone who has currently an incorporated business with a minimum of $10,000 in income, I'd say 5 to 10,000, and someone who wants to reduce their future tax consequences. I mean, who doesn't want that, right? Why? Well, at this particular point, you've been deferring. So when you started your qualified account, and it doesn't really matter which one, you did so by taking money that you didn't really pay your taxes on, right? So you're deferring your taxes. And if I simplify and give you a simplified case, here's what it would look like. Let's just say that you have about $1 million. And typically when someone has about $1 million, they fall into a tax bracket between, let's just say, 30 to 40%. So at this particular point, we said, okay, let's say that your tax bracket is about 40%. So you get 600,000, and Uncle Sam will take $400,000. And one of the reasons I put this up here is for you to actually see what that looks like. And whenever I see that, that doesn't make me feel very good. How about you? How does it make you feel? And I understand that if you have a CPA that is brilliant, he might, again, get you down to maybe a 30% marginal tax rate. In that case, you would owe the government $300,000 and you would keep $700,000. But what about if you could keep some of that money for yourself? I could think of many reasons on what I would do, what I would do with that money. So what is it? Well, essentially, it's a strategy that will minimize your tax consequences by 35 to 40%. And as I said before, By the end of this webinar, I will give you the opportunity to schedule a one-on-one call with me so that we can talk about your particular individual scenario and see whether this will benefit you. And, hopefully we can help you to set this up. This, again, is not for everyone. You probably figured so much. You have to qualify for this, and I hate wasting anybody's time. So if you look at this and you don't meet any of these requirements, feel free to stay on because it's interesting information. But you have to meet those requirements in order for us to actually work this strategy with you. So as I go through this list, let's just say you look at it and you say, well, I'm close to these requirements, but you're maybe not quite there yet. Perhaps you're under 50. Yet you have an interest in wealth building, protection, and tax mitigation strategies. I invite you to stay on for the next few slides as I'm telling my brief story, and then I could email you or you can email me so that we can talk about your individual situation and what it is that you want to accomplish, and I will be able to help you. Okay, so here it is. Who is not a fit is someone who has less than $350,000 in their qualified account. Now, I know I said we need a minimum of, or we look at a minimum of $500,000. That is true, but we have worked with individuals that had $350,000, however, they met all the other requirements. So there's the difference. Someone who is also not a fit is someone that cannot or doesn't have and can't incorporate another business. This is one element that we can help with. We can create a business for you. It doesn't really matter whether it's a CS or an LLC. We can help you to create that business with a federal employer identification number, and we'll show you how to make a minimum of $5,000 to $10,000 a year. Another person that doesn't fit here is someone who absolutely needs the amount that they've accumulated in their qualified account, and now will pay their taxes if they withdraw a lump sum, or pay taxes on the distributed amount that they will take out, and then will live off that money that they're taking out. In other words, they create their own formula and will live off that money because they don't have anything else. So this is the only money that they have. They don't have another annuity. They don't have mutual funds. They don't have stock portfolios, income from an investment property, or something where you have other income coming in. If you, again, I want to make sure that you understand, if the qualified account is the only income that you have, then this might not be a strategy for you. And then we're looking, or someone who's not a fit would be someone who has less than 10 years. I mean, let's be clear, it took us about 25 plus years to accumulate this amount of money, between 500 to $1 million plus. It's going to take a couple of years to transition from a qualified to a non-qualified account. All right, so meet me. I was born in the Czech Republic, lived in Germany, and became a tennis professional while in high school. And then came over here and got all my undergrad and grad school and postgrad here in the US, and I made Central Florida my home since the 1990s. I also, in 2009, became the honorary consul to the Czech Republic. As a matter of fact, as of May, I'm the honorary consul to the Czech Republic in the entire state of Florida. The only reason I'm bringing that up is in this industry, all of us, financial advisors, investment advisors, planners, wealth strategists, wealth advisors, managers, and so forth, they're after gaining trust with their clients, and will obviously the ones that, much like me, who think that people should trust them because we're doing the right thing for you, are finding new ways. And so it's not that I took on this responsibility to gain trust with my clients. It's just that I feel that I was picked, and then when I was investigated, I was checked out by the U.S. State Department, by the FBI, and the Czech Republic, the country, and my records are squeaky clean. So if they can trust me, I'm thinking that you could start trusting me as well. This picture before I go into my financial career was taken at the beginning of this year. I was invited to speak in front of some young students, the Yelp Association, one of the brightest students in Central Florida. And to my surprise, a pleasant surprise I may add, these kids were, or students I should say, were very interested in how to build wealth, how to maintain, how to distribute, and what kind of jobs. So it was fun, a fun 2 hours that I spent with them, and I really enjoyed their questions. I started my career a little bit differently, and one of the reasons I'm bringing this up is because it's very important to understand, for you to understand where I'm coming from, and why I actually can and find where I find these strategies, because they've been around for quite some time, being utilized by some of the wealthier people in this country. I was very fortunate at a young age to run one estate, a very large estate in the hundreds of millions of dollars. It's a whole other story how I got there, but I had the opportunity and I consider myself very fortunate. I assembled a team of experts, a tax attorney, a CPA, and business consultants, because I knew that I wouldn't be, I'm not an expert in everything. I'm young and I know what I don't know. And so I absolutely knew what I had to do. And that's really where I also learned, that's where I learned my craft, from these experts, and then hands-on applications with my clients. And the client was the patriarch, the matriarch, and then a multi-generational family. We did absolutely everything. We crafted solutions that would fit that family. In my case, it was income for life and minimizing taxes. And very important to the patriarch, not only running an operation or running multiple operations, but also find profit centers and build them into businesses, successful, I may add to that, and then move on and do something else. I did that for almost a decade before becoming a partner in a multifamily office, which is really a single family office offering a la carte services for multiple wealthy individuals and families. And they may be athletes, they may be doctors, they may be entrepreneurs, business owners, much like yourselves. Those were individuals and families who were valuing and who value the concierge service that we provided. And they understood that we were taking from them the financial complexities. So we took the financial complexities out of their life so they could pursue whatever it is that they needed to. You know, some wanted to just spend more time with the family, and some just wanted to focus on their business and knew very well that they couldn't do everything on their own and they needed help. And that's where we came in. Unfortunately, global economic circumstances, it only lasted for so long. But at the same time, I was also sought after by a local regional investment bank that was looking for a wealth manager that had family office experience. And so I thought that was a great fit and great timing. And I took on the job. I became one of two wealth managers who was managing individuals that had $5 million at a minimum of investable assets. At the beginning, it felt like a perfect fit and perfect family office, only to find out later that really what we were doing, we were boxed in and were not able to absolutely help our clients to our best knowledge and implement strategies that would actually help our clients, but rather had to use what the institutions dictated us using as far as products and strategies. And if I may make this comment, and I allow myself to do it because I've worked for them, you can walk around any city and you have these reputable big name institutions. They usually have their name attached to a building. You probably know what I'm talking about, and there are many of them. If you think that you as the client are their priority, I got to tell you to think again, because the first priority for an advisor and for the head of the advisors is shareholders' wealth. We need to make sure that we meet our quota, and at the same time, we also want to make sure that we sell the products that our institution develops for our clients. And that's not in your interest, but it's more in their interest. And so after a while, I disagreed with those values. It just didn't fit with me. And here we are. SkyWealth Alternatives was born. I became an independent wealth strategist. And as I said, SkyWealth Alternatives was born. So, this is interesting. I am meeting with pre-retirees and retirees on a regular basis. You know, the ones that are several years out, the ones that are only a few months away, and of course the ones that are already retired. When I start talking to them about their qualified account, in this particular case, they are just so very, very surprised when asked to pay Uncle Sam his share on the qualified account. It seems to me that the term tax deferral is used once when the account is set up and then quickly forgotten. Then when it is time to pay Uncle Sam, a lot of people have a rude awakening. Oh my God, we have to pay Uncle Sam a lot of money. Where did we go wrong? How did that happen? Hopefully you're catching my drift here. That's why I'm doing this webinar, and I'm looking for people, I'm looking for individuals that are between 50 and 65, because that's about 10 to 12 years prior to that revelation that you would have when you start taking the money out. You know, ideally, I want to meet you before you start taking monies out, and show you how you can plan on how to distribute those funds and minimize your tax consequences. Does that make any sense to you? Hopefully it does. So are you ready? The IRA recapture, again, is just to clarify that we know what we're talking about, is for a client ranging age 50 to 65 who has amassed circa $500,000 plus in a qualified account, is aware that at age 70 and a half, latest, the IRS will come knocking on his door or her door and wanting to share of his or her investment. And we will discuss a strategy based on sound principles backed by IRC codes that will allow the individual to reduce their taxable income by approximately 35 to 40%. Hence, pay much less taxes, convert your qualified account into a tax-free environment with living benefits, disability benefits, and tax-free death benefit. Now that sounds pretty good, isn't it? Or doesn't it? Again, you can see Mary Reed. She is the National Director of Pension Protection Planning. She's a qualified pension administrator. And again, what I just said before, and I want to make sure that you understand that, she is the compliance officer. She works with the IRS, and she will make sure that we're on track and we're doing the right thing. Okay, so this is the slide I want you to see. I have a lot of stats for you if you need it. I really don't want to talk about all the numbers. When we do our one-on-one, I'm more than happy to pull out all the numbers and all the stats for you, and we can talk about it. One of my studies is in economics, and so I'm all about science, math, and economics. And I have my opinion, and I read a lot, and I can share with you what I know, and we can compare notes if that's what you want. However, for the sake of keeping you guys awake, because I know that I've been the only one talking, and I don't know whether you can follow me, whether it's too much information at once. But in order for you to keep awake and really catch the drift of this strategy, and we're getting there almost, I'd rather tell you another story, a story about another subject within retirement that doesn't really have to do with what we're talking about, but the principle of it is the same. Let me just, it just takes me a couple minutes. About 2 weeks ago, the president signed a bill on Social Security that will change for the worse your ability to maximize your Social Security payouts forever. And that change was in Section 831. Now, I could go into more detail, but again, once we have our one-on-one, I can go into details there. As a matter of fact, it was the most drastic change in that department, the Social Security department, in the last 40 years. The only thing that I want you to know is that if you do not turn 62 this December, you will adhere to the new Social Security rules decided on 2 weeks ago. Again, this webinar has nothing to do with Social Security, but how this change came about is potentially very similar to what I'm about to tell you. This Social Security deal, end quote, was decided under the radar, and even today, only few people know about these changes that took place, and there's really not a lot of coverage around it. Not even the presidential debates are really talking about it, which is very surprising. So what I want you to do is just look at that number up on top. We're approaching $25 trillion in retirement assets in the second quarter of 2015, right? Which is about 6 months ago. Well, our national debt currently is at $19 trillion. And whenever we talk about our debt and whenever, actually, when you listen to the presidential debates, one of the topics that they're talking about is how they're going to reduce debt. Well, do you think that it is perceivable that the government has potentially its eyes on those retirement funds? You bet they are. They absolutely are. It's no longer a theory, but it is actually a reality. 2 years ago, a professor, and I'm not going to name who it is, but I know who it is, and I've been reading papers and white papers from that person, from a famous university up north, proposed for the government to manage all qualified accounts. So the way they would look for us is that we would be forced to hand over our qualified account to the government, and they would manage it for us and provide us with a fixed 2 to 3% return. That's what's being currently discussed in Washington, D.C. How does that make you feel? You see the connection there? If we take only if everyone was paying, or on average, if people were paying 25% marginal tax rate, then that amounts to about $6.8 trillion. If they had that money and could pay down the debt, that would be something, wouldn't it? It's enough. That's a lot of money already. So let's review information that you probably know inside out, but I want us to be singing out of the same book. Therefore, we're just going to go through this very quickly. And I think that, of course, I can't be talking about everything. But if you're like me, you probably want to know and see how things work and not just rely on an expert talking. You want to see for yourself. This really describes the pre-retirement and retirement phase. So before 59 and a half, if you were to distribute any funds, doesn't matter how much, you'd be subject to a penalty and ordinary taxes. And then comes the normal, the 11 years of a normal retirement age between 59 and a half and 70 and a half, where if you were to distribute any funds, you would be able to just pay your ordinary taxes, and that would be it. And by the way, let me backtrack here. In the premature distribution, if you were to take monies out and only keep them below 60 days and pay them back, in fact, you would not have to pay any penalties, and there would be no taxes charged on that money. So 60 days is the magic number. So coming back, at 70 and a half, if you haven't taken any money at that particular point, you will be forced to take money. Otherwise, a hefty penalty and ordinary income tax or taxes will be waiting for you, or may be waiting for you, because there are some potential strategies that might mitigate that. So let's look at some of the current strategies out there that have been out there for the longest time, and unfortunately are fading away or are not really helping you with the taxes. They might going forward, but first you have to pay the taxes, and then you have to pay your taxes, but then once you're in it, everything that works in that vehicle will be tax-free. Anyway, what I'm talking about is the first thing I want to be talking about is the stretch IRA. Surviving spouse could always roll the deceased spouse's account to his or her own IRA, and that's called stretching the IRA. The concept of the stretch IRA is the ability of the surviving spouse to treat the deceased spouse IRA as his or her own. The RMDs, or required minimum distributions, are calculated based on the uniform lifetime table during the life of the surviving spouse. Children are allowed at this particular, or up until a certain year, were allowed to take distributions over their life expectancy following the death of the surviving spouse. The stretch IRAs are designed for individuals who do not have a need for the money in the account and wish to stretch the money over the lifetimes of named beneficiaries. By doing a stretch IRA, the IRA owner generally assumes that the IRA will distribute the smallest amount possible that the tax law allows, and while the IRA owner is alive, and a constant rate of return. Unfortunately, that doesn't happen all the time. Unfortunately, in 2014 and 2015, it came to a halt. The payments must now be made to beneficiaries within 5 years. So you could use this in a limited fashion. It doesn't really work the way that it used to work before. The other part would be the Roth conversion. I mean, everyone probably has one. Hopefully you do too. And this goes hand in hand with other strategies as well. With the Roth conversion, you eliminate federal income tax on your future withdrawals. You watch your money grow tax-free indefinitely, because as the IRA owner, you won't have to take required minimum distributions at the RMDs during your lifetime. And you can leave the IRA as a tax-free bequest for your heirs. Your heirs will have to take annual RMDs, but they won't have to pay any federal income taxes on those withdrawals as long as the account's been in place for 5 years or longer. So here is our strategy. Here is what because none of these strategies that I just talked about come even close to what this can do. We call it distribution alternative. Here is how it works. Look at the upper left-hand corner. We need a qualified account, an IRA, 401k, what we've talked about before, and the famous company that I was talking about, an S Corp, C Corp, LLC, that show a minimum income of $5,000 to $10,000 annually and have an FEI number, meaning a Federal Employment Identification Number. At the same time, we're going to construct a profit-sharing plan, which will serve as the chassis or the vehicle that will house a specific life insurance. Hence, you can see those 5 arrows coming from the IRA and the dollar signs down. Those are 5 years. And we will purchase a specific life insurance, as we said, that will remain within those premises of this vehicle for the next 5 years. We're going to front load the specific life insurance with all the cost, and then we'll bring down the cash value to a minimum. Trust me, it works, and it takes a specific life insurance to do that with. You can't pick up that life insurance from a shelf and say, okay, I'm going to do this. It doesn't work that way. Once fully funded, the profit sharing plan, will be collapsed. I mean, sorry, once fully funded, the profit planning share chassis, the vehicle, will be collapsed. And the taxes will be paid on the reduced amount, which ends up around 35 to 40%. And as a matter of fact, I will show you an example on what that is in a minute. What you're looking at, the reduced amount is calculated by IRS formulas. And that is called PERC, P-E-R-C. It's premium plus earnings minus reasonable cost. And I actually put that down. The amount that you will be left with is will now be growing within that life insurance with only the insurance cost, which is very little, at around, typically we see 7 to 8%. And it's not guaranteed, of course, for another 5 years. The end result from that is tax-free income and a tax-free death benefit. I know this went fast and we're simplifying it, but it works, and we're going to show you an example here in a minute. So let me show you a comparison between what we just talked about and what it would look like if you just had a business and you were just distributing your IRA. Let's just assume there's a business owner. He's making $50,000 in earned income, has no employees, and $1 million in his qualified account, and his tax rate is at 35%. So two choices: you either take the lump sum, pay your taxes, or you distribute. Either way, your tax consequences at 35% will be $350,000. You'll be left with $650,000. Versus with us, you would pay the $1 million in premiums over 5 years, and upon initiation, the initiation of the life insurance, you will receive a tax-free life insurance death benefit at $2.6 million, roughly. Now, I want to make sure that you understand how we came up with these numbers. These numbers depend on the rating of that particular individual and his age or her age. The unisex, it doesn't really matter whether it's female or male, but it certainly depends on the rating and the age. So at this particular individual, it is $2.6 million that he's receiving in a death benefit should something happen to him. And the PERC value at the distribution based on that will be about $626,000. And because of that, we'll pay 35% taxes on that, which amounts to $219,100, which gives us a tax savings of almost $131,000. I mean, isn't that great? $131,000. What would you do with an extra $131,000 that you didn't have to pay to the IRS? It comes with more than that. It comes with policy benefits. It comes with, as we said before, tax-free death benefit, and of course, it's the estate tax-free. It comes with tax-free income through that benefit rider, and there are no additional costs to the benefit riders that will allow you to pay for chronic illness, critical illness, lifetime income. Lifetime benefit riders come through a lifetime income benefit rider that guarantees stream of income for life at retirement. And we'll show you exactly how that works in an example in a second here. And it gives you money for terminal and chronic and critical illness. And the way that you do it is by the insurance company allowing you to access all or part of the death benefit if diagnosed with any of those illnesses. And it also may help to pay some of these items that I mentioned in that slightly blue or gray box that you can see. Right here, even if you're not, I want to make you aware of something. When you retire, the dynamics change. And so my question to you would be, what's more important to you at retirement? Is it more important to you that you have a number in a statement, which is an unrealized gain? Because at this particular point, unless you liquidate it, it's just a number on a piece of paper. Or is income that you cannot outlive, a lifetime income, as we've talked about, stream of income for life at retirement, is that more important? Well, I hope you're saying that income is more important, because that number on that piece of paper will depend on a lot of different factors. It may be an opportunity, but it may be a risk. It's subject to market risk, it's subject to sequence of returns. And when you are close to retirement, about 10 years prior to that, you should minimize your exposure to rate changes. And here's an example. If the market grows at 8%, but does that mean that you can actually take out 7% every single year out of your stock portfolio? The answer to that is no, because that's not what the market does. It's an average number, but it doesn't give you the ups and downs. And if you are depending on your market-driven investment, then you always will have to take your monthly payments, your semi-annual payments, or your annual payments from that investment. And what happens if 1 month or 2 months, 3 months in a row, the return of the market is negative? You still have to take the money, but now you suddenly are killing the workers that are there to actually create that income for you. And that, my friends, is definitely a very quick way to losing all your money. So, just like we've talked about a second ago, your other choices would be to invest, and you definitely be subject to the performance of the market. It may be better or may be worse. You're the one taking the risk, and at the end, you may lose money. As far as taxation is concerned, you still will be taxed upon distribution, either as a lump sum or a part of it. Future taxes may be higher. That's up to you, whether you think that our economy is at such where there's no way that the tax rates are going to come down. I have my opinion, but this is up to you. And you still have that mandatory required minimum distribution at age 70 and a half that you can't forget. Usually when you're, for sure, when you're in a driven market, market-driven investment, you just have assets. You do not have any of those benefits, like the chronic illness riders or the terminal illness riders, or a lifetime income guarantee or death benefit. Doesn't exist in there. So how are we doing so far? I know it's a lot of information, and hopefully you are not asleep yet. We're almost there. We're going to give you two charts. So here is the example that I was talking about. Here's this special life insurance. Let's just assume we had $1 million that we're trying to unload. We're age 55. So every year for 5 years, we unload $200,000. At the end, as we said, and by the way, we're growing it at 5% for the first 5 years, and we have a 40% personal tax rate. This is fixed. The 5% is fixed, and the income per the IRS calculation, remember the PERC calculation, when we collapse the profit sharing plan, is about $617,971. Now, remember, that number was a little higher, and that was because of the rating and the age of that particular individual. And here it is a bit different. So again, it's a different person. Our taxes due would be $247, but look at our income. Our income stays steady past age 100, because if you look at our cash value in the fourth column, we're still at $868,000, and we're going strong. There's no side of losing or running out of money. This, by the way, the $75,719 that you see, you at a 35% marginal tax rate, you would have to make a gross $101,000, and at 40%, it's somewhere around 110,000. So in other words, you have to make 110,000 in order to make net 75,719. Let's compare that with a Roth. We have $1 million. We still grow it at 5% for 5 years. We then pay our taxes, and we end up with $729,000. That's wonderful, and it looks great. But unfortunately, after 15 years, we run out of money. You can see the 54, that's what's left in year 15. So which one is better? I would say that the first one is much better. So if we compare one more time the IRA as well with the life insurance, here's what we get. We reduce our taxation, we eliminate the RMDs, required minimum distributions. The IRA, to do similar things, but not quite as effective, would be the Roth conversion, because we will have to pay our taxes on that. Maybe do a stretch IRA, limited. And then, of course, we can still invest. We'll have an opportunity, but we'll also take a risk. And then we could annuitize at the end. But let me warn you here, the latest calculations that come from the American Financial Institute, Dr. Pfau, suggest that we only can take about 2%. So if you had $1 million, you really could only take out $20,000 a year. Again, when we have our one-on-one call, I can go into this in more detail. But is $20,000 enough for you? I mean, again, that's not for me to answer. With the life insurance, you have a tax-free death benefit. You have a tax-free income. You have a policy investment strategies. And you have living benefits. Remember those? We're talking about all the different illnesses that we would be able to cover to a certain extent, depending on the amount of death benefits that we have. But you know, with $3 million, you're ahead of the game, I think. So here is something that is also very dear to me, and something that I want to make you aware of. Living benefits. It's a very important topic. People don't really think that it is, but it is. Here's why. The odds of your house burning down is 3 out of 100, but nearly every homeowner has a homeowner's insurance. The odds of you totaling your car between now and the day you die are about 18 out of 100. Yet nearly every automobile owner carries auto insurance. Now listen to this. The odds that you will need some sort of long-term care, some kind of disability care between now and the day you die, listen, are about 72 out of 100. However, less than 30% of Americans over the age of 45 have purchased any type of disability or long-term care insurance. Isn't that incredible? So here you have a vehicle that reduces your taxation, gives you a lifetime income, eliminates the RMDs, gives you a tax-free death benefit, and also gives you if not the full package, but at least a huge head start on your living benefits. Because if 72 out of 100 need some kind of help, some kind of long-term care, and you have nothing set up, you know what the saying is, that's a sure way to bankruptcy. If you had to self-fund your long-term care. So you want to make sure that that doesn't happen. And again, this strategy just covers it all. It's fantastic. So do you qualify? Let's go to this very quickly because I know you guys are getting antsy. Do you have earned income to support the 401k profit sharing plan? In other words, you have the $10,000, and can you contribute a little bit to the 401k, even if it's a couple bucks? Is there an exit strategy in place for your pre-tax money? Well, if not, please think about the strategy. Is minimizing taxation on pre-tax money important to you? If it is, this is a home run. Do you desire tax-free income? Same thing. Are you concerned about required minimum distributions at the end at 70.5? Is there interest in increasing benefits for your beneficiaries? Do you have an interest in guaranteed income? Do you need life insurance for estate planning? Well, as a wealth planner and having been involved with pretty much every type of person there is, I can tell you for sure 100% that you need life insurance for estate planning. So you don't even have to think about that. And do you need long-term care? Everyone needs some kind of long-term care. This particular strategy will, as I said, either take care of it or at least give you a good head start. And the question, though, will be whether you're insurable. And even if you're not, we have other solutions for you if you're not insurable. Okay, so you're ready to discover if you can keep more out of your money with the IRA recapture? I would hope so. And if you are, I hope that you will consider giving me a call, and we can make a one-on-one call, and then maybe schedule a meeting and maybe have a face-to-face if we're close enough. Until then, I thank you very much. And you will get the information, I guess, in a package on how to contact me. And until then, I hope you enjoyed this seminar. I know it has been a webinar. It has been a while. I know we took about 50 minutes here. I've enjoyed myself, and hopefully you did too. And thanks so much. Bye-bye.